In Q1 2026, XRP futures and options on the CME group generated $13 billion in notional trading volume. $13 billion in one quarter on the world's largest and most regulated derivatives exchange. And the spot price of XRP right now is $1.42. That is not a contradiction. That is a blueprint. Because $13 billion in regulated derivatives volume, with declining leverage ratios, growing institutional open interest, and 29 large open interest holders on a single exchange, is not retail speculation. It is institutional positioning. And when institutional positioning through derivatives converts to direct spot access, the historical pattern of what happens next is very specific and very fast. Here is what makes this particular data point more significant than any previous XRP derivatives milestone. The $13 billion in Q1 2026 is not a headline volume number. It is a structure signal. CME analysts published this alongside a specific observation. XRP derivatives are showing steadily declining leverage, a pattern they identify as excess speculation being cleared out. When leverage drops while volume stays elevated, it means the composition of the market is changing. Speculative retail leverage is exiting. Institutional directional exposure is entering. That is the fingerprint of a market in transition, not from bearish to bullish, but from speculative to structural. And the infrastructure that makes the structural phase possible was assembled through a $200 million acquisition that most XRP holders read as a retail play and immediately scrolled past. So here is the question that should be sitting with you before we go any further. If institutions are already building $13 billion in quarterly exposure through regulated CME derivatives, why are they using derivatives instead of spot? What specific regulatory constraint is keeping that capital in the futures layer rather than the spot market? And what happens to the spot price of XRP the moment that constraint is removed? The answer to that question is the most important structural argument in this entire breakdown. And it connects directly to an acquisition that happened and a regulatory framework that is weeks away. Let's build it from the ground up. This is XRP News Flow Signals. We track CME position data, institutional filing flows, regulatory mechanics, and on-chain infrastructure, and we map them to price without the narrative layer. Let's get into it. Let's be precise about what CME published in their Q1 2026 report, because the number is less important than the structure behind it. Bitcoin futures and options, $378 billion notional in Q1 2026. Ethereum, $155 billion. Solana, $21 billion. XRP, $13 billion. On the surface, XRP looks like the smallest number on that list, but here is what that comparison misses entirely. Bitcoin futures launched on the CME in December 2017. Ethereum futures launched in February 2021. XRP futures launched in May 2025, less than 12 months ago. XRP hit $1 billion in open interest faster than any contract in CME history, surpassing the speed at which Bitcoin and Ethereum reached the same milestone. By August 2025, just 3 months after launch, XRP had 29 large open interest holders, a record for any new CME contract. By Q3 2025, XRP futures had generated $23.7 billion in cumulative notional volume, making it one of the fastest-growing institutional derivative products the CME has ever listed. CME does not list products for assets they doubt. Their listing process involves regulatory review, clearing requirements, and an assessment of whether sufficient institutional demand exists to sustain the product. When the CME listed XRP futures in May 2025, they were not giving XRP a participation trophy. They were making a structural determination. XRP is a derivatives-grade asset, and the Q1 2026 data confirms that determination was correct. But that's not even the most important part of this story. What I'm about to show you next is what connects the CME derivatives layer to the spot market through a $200 million acquisition that was announced as a retail play and is actually something completely different. That's next. In June 2025, Robinhood completed its $200 million acquisition of Bitstamp. The headline was Retail Expansion. Robinhood growing its crypto offering. New markets, more users. That is not what actually happened. Bitstamp is one of the oldest continuously operating cryptocurrency exchanges in the world. Founded in 2011, still operating. And here is what makes it structurally irreplaceable. Bitstamp holds regulatory licenses simultaneously across the European Union, the United Kingdom, and the United States. That multi-jurisdictional regulatory stack took over a decade to build. You cannot replicate it. You can only acquire it, and you pay what Bitstamp was worth to get it. But the regulatory licenses are not the most important part of what Robinhood bought. Bitstamp runs deep XRP infrastructure. It has been one of the primary institutional liquidity venues through which Ripple's on-demand liquidity corridors have operated for years. Bitstamp processes institutional-scale XRP transactions daily. Several stablecoins are already issued natively on the XRP Ledger through Bitstamp's integration. Bitstamp has publicly stated its intent to build a global derivatives exchange powered by the XRP Ledger, leveraging XRPL's speed, settlement finality, and efficiency to offer a product that legacy derivatives clearinghouses cannot match. Now combine that with what Robinhood did next. 1 week after completing the Bitstamp acquisition, Robinhood launched micro futures contracts for XRP. CME modeled, cash-settled, regulated, accessible through standard brokerage accounts. Each micro XRP futures contract represents 2,500 tokens, currently valued at approximately $3,500. Lower margin requirements, institutional-grade execution, direct access for retail accounts that cannot hold spot crypto under their investment mandates. Think about the complete stack. Robinhood, 23+ million funded accounts, retail reach. Bitstamp, multi-jurisdictional regulatory licenses, institutional XRP infrastructure. CME, regulated derivatives framework, CFTC oversight. XRPL, 3 to 5 second settlement finality, sub-cent transaction costs. This is not a crypto company building a product. This is a regulated financial institution assembling the complete infrastructure for XRP to operate as a global derivative settlement layer, and paying $200 million for the regulatory piece it couldn't build itself. Now, before you read that as a clean institutional bull case, there's a specific constraint that explains why all of this infrastructure exists, and the spot price is still at $1.42. Understanding it is the difference between knowing that something is coming and knowing exactly what triggers it. That's next. Here is the specific regulatory mechanics that explains the gap between $13 billion in quarterly derivatives volume and a $1.42 spot price. Most institutional investors, pension funds, insurance companies, endowments, 401k providers, corporate treasury desks operate under investment mandates. Those mandates define exactly which asset classes they can hold. In most institutional mandates today, direct spot crypto ownership is explicitly excluded. The language typically reads, no direct exposure to digital assets, or no unregulated securities. But those same mandates do not exclude regulated derivatives. A futures contract on the CME, cleared through a CFTC-regulated clearinghouse, settles in USD and is treated as a commodity derivative, not as a digital asset. That means fund managers who are legally blocked from buying XRP spot can still trade XRP futures contracts, are legally permitted to build XRP exposure through CME futures. That is the capital sitting in the $13 billion. It is not speculative retail money. It is institutional capital that wants XRP exposure and is using the only legally available channel to get it. The moment the Clarity Act passes, embedding XRP's commodity classification into federal statute, The legal language in those investment mandates changes. XRP spot becomes a regulated commodity under federal law. The compliance justification for excluding spot XRP evaporates. And when institutional capital that has been channeling through derivative suddenly has legal direct access to spot, the mechanics of what happens next are not speculative. They are the same mechanics that played out when Bitcoin ETFs were approved in January 2024. In the 72 hours after Bitcoin ETF approval, Bitcoin's spot price moved 15%. Not because new buyers appeared, because existing buyers who were channeling through futures converted to direct spot access simultaneously. XRP's derivative space is smaller than Bitcoin's was at ETF approval, but the structural dynamic is identical, and the trigger, Clarity Act passage, is now measured in weeks. And that brings us to the part most channels won't calculate, because it requires connecting the derivatives volume to the supply mechanics on the spot market. And when you run that math, the number that comes out changes how you think about what you're holding. That's next. Let's run the supply math the way institutional desks run it, from the bottom up, not the top down. Current XRP exchange reserves approximately 2.6 billion tokens. That is the total liquid supply available for purchase across all major exchanges today. 7 spot XRP ETFs currently hold approximately 773 million tokens in custody. That is already 30% of available exchange supply locked away. JP Morgan's institutional forecast for XRP ETF AUM, $5 billion in year one. At $5 billion AUM, ETFs would hold approximately 2.5 billion tokens, nearly matching the entire current exchange reserve. Now layer on the Robinhood Bitstamp XRPL derivatives layer. If Bitstamp builds its XRPL derivatives exchange, and the regulatory framework is now in place through Bitstamp's existing licenses, every derivatives transaction on that platform requires XRP as the settlement layer, not as collateral, as operational settlement infrastructure. XRP that functions as settlement collateral is not available for exchange purchase. It exists on the ledger, but it is operationally committed. The global derivatives market processes notional volume measured in hundreds of trillions annually. Even at XRP's current Q1 pace of $13 billion per quarter on CME alone, the settlement XRP required grows proportionally with volume. Now add the BIS estimate, $27 trillion, trapped in Nostro Vostro accounts globally. If Ripple's ODL displaces even a fraction of that pre-funding requirement, the XRP transacted through those corridors creates additional structural demand on top of ETF custody and derivative settlement. 3 demand vectors, 1 supply pool, 2.6 billion tokens on exchanges, and the institutional adoption cycle has not fully activated yet. If you're tracking this kind of structural supply-demand analysis, connecting CME data, regulatory mechanics, and on-chain supply, this is what XRP News Flow Signals builds every week. Subscribe if this is the level of analysis you've been looking for. We cover the infrastructure before the price reflects it. Let's close with a number that is genuinely too large for most people to process correctly, and what it actually means. The Bank for International Settlements estimates the total notional outstanding value of global over-the-counter derivatives at over 700 trillion. Add exchange-traded derivatives, and the number approaches 1.2 quadrillion. That is not a crypto number. That is not inflated by token issuance. That is the measured size of the global derivatives market. Every interest rate swap, every currency option, every commodity future, every equity derivative, processed through systems built in the 1970s and 1980s. Those systems have 3 structural problems that the XRP Ledger solves at the architectural level. 1. Settlement latency. Current derivatives clearing takes 1 to 2 business days. During that window, positions are exposed to counterparty risk. XRPL settlement, 3 to 5 seconds. Finality guaranteed. 2. Cost. clearing fees across traditional derivatives infrastructure at fractions of a percentage point to every transaction. At quadrillion-dollar scale, those fractions equal hundreds of billions annually. XRPL transaction cost $0.002, fixed, regardless of notional size. 3. Availability. Traditional derivatives clearing closes on weekends. The derivatives market does not stop caring about risk on Friday afternoon. XRPL operates 24/7, 365. Now, here is the only number that matters for your position. If 1% of that 1.2 quadrillion market uses XRP as a settlement layer in any form, that is $12 trillion in annual XRP demand. If it is 1/10 of 1%, $1.2 trillion. The current XRP market cap is approximately $80 billion. This is not a moonshot calculation. It is an arithmetic statement about what happens when the world's largest market uses the world's fastest settlement layer. Here is the complete picture. CME published Q1 2026 data in the last 24 hours. $13 billion in XRP futures and options volume. Declining leverage, institutional composition, 29 large open interest holders, a record for any new CME contract. Robinhood acquired Bitstamp for $200 million, not for retail expansion, but for multi-jurisdictional regulatory licenses, institutional XRP infrastructure, and a stated plan to build a global derivatives exchange on the XRP Ledger. Bitstamp already has stablecoins issued natively on XRPL. The settlement architecture is already in place. The constraint keeping institutional capital in derivatives rather than spot is the absence of permanent legislative clarity. Specifically, the Clarity Act's commodity classification in federal statute. That constraint has a 60-day window before the legislative opportunity closes. The supply on exchanges is 2.6 billion tokens, the lowest since 2018, and ETFs alone are already holding 30% of that supply in custody. The infrastructure is real. The institutional positioning is documented. The supply is compressed. The regulatory trigger is weeks away. What the $13 billion in CME volume is telling you is that institutions are already building XRP exposure through every legal channel currently available to them. The spot market is the channel they don't have access to yet. That is not a forever situation. Watch the Clarity Act Senate Banking Committee calendar. Watch the Warsh confirmation and its impact on Fed custody guidance. Watch Bitstamp's XRPL derivatives platform announcement, which is the next logical step after everything they have built. Those three events will tell you when the derivatives to spot conversion begins. And that conversion does not come with a warning. This is XRP News Flow Signals. Data, not hype. Every time.